Norway is sitting on $2 trillion. They own 1.5% of every public company on Earth, yet they are one of the most broke countries on Earth. Broke in ambition, which could have dire effects on their economy. But here's the thing, they have all the money in the world to fix it, so why can't they? The answer isn't what you'd expect. It's not corruption, it's not incompetence, it's something far more dangerous. A trap they built themselves. And to understand how they fell into it, we have to go back 50 years. In 1969, Norway discovered oil in the North Sea. It was a moment of pure luck. Oil became their main export and a huge source of wealth. But as that wealth grew, the government became increasingly concerned about an economic terror known as Dutch disease. If you spend all that oil money inside your own borders, you cause massive inflation. Your currency explodes in value, your wages skyrocket, and suddenly, your other industries, fishing, manufacturing, timber, can't compete globally because they become too expensive to export. You become rich in oil, but poor in everything else. So Norway made a radical decision. In 1996, they deposited the first oil money into their new main sovereign wealth fund. However, they put themselves into a voluntary golden straitjacket. They mandated that the fund must invest 100% of its assets outside of Norway. They would buy stocks in New York, real estate in London, and bonds in Tokyo. But they would legally ban the fund from investing a single krona in Norwegian infrastructure or businesses. To enforce this, they implemented the handlingsregelen, a budgetary rule that limits government spending to just the expected real return of the fund, roughly 3% per year. The principle remains untouched. So Norway made a choice. Export the capital, keep the country stable. For 30 years, it worked. But then, something changed. The boring strategy that saved them started to destroy them. And the irony is almost cruel. The wealthier they became, the weaker their economy got. But how is that even possible? How does having more money make you weaker? To see why, compare Norway to a country that made the opposite bet, Saudi Arabia. Look at the Saudi Public Investment Fund. It is aggressive, flashy, and deeply active. The Saudis are buying golf leagues, funding futuristic cities like Neom, and trying to force a diversified economy into existence through sheer spending power. Norway chose the opposite path. They chose to be boring. The fund's strategy is currently allocated to about 70% equities, 25% fixed income, and a small 5% sliver for unlisted real estate and renewable infrastructure. It tracks global benchmarks with almost no deviation. It is the world's largest passive investor, designed to be transparent, predictable, and safe. Previously, this strategy insulated the Norwegian economy from the roller coaster of oil prices. When crude crashed, the Norwegian krona didn't collapse because the fund was diversified into thousands of global companies. But this success created a paradox. By designing the perfect insurance policy, Norway decoupled its national wealth from its own industrial performance. The country became rich regardless of whether its domestic industries were innovative or efficient. This created a golden straitjacket. The money is there, visible on a screen, growing by billions every quarter, but it is legally inaccessible for the one thing Norway might actually need: restructuring its own economy for a post-oil world. They sent their wealth abroad to keep their economy stable, but in doing so, they inadvertently starved their own ambition. The result? A situation that looks suspiciously like capital flight, only it's state-sponsored. Think about the mechanics here. When a Norwegian oil platform pumps a barrel of crude, that value is captured, taxed at 78%, and immediately sent to purchase shares in Apple, build infrastructure in Berlin, or fund real estate development in Vancouver. It's like Norway is taking money out of its own pocket to make other countries richer. Norway is effectively stripping its own economy of capital to fund the growth of its competitors. So where does the remaining domestic capital go? If you're a wealthy Norwegian with money to deploy, you aren't incentivized to build a business. The tax code sees to that. Norway levies aggressive taxes on income, dividends, and wealth, but it has a massive blind spot: primary residences. The system is rigged to favor home ownership over entrepreneurship. So the money that doesn't flee abroad doesn't go into startups or factories. It goes into concrete. Housing prices have climbed 56% since 2016, even as housing starts have declined. Unlike New York or London, where foreign oligarchs drive up prices, this is a purely domestic bubble. It's fueled by a tax code that tells citizens the smartest investment isn't a new company that creates jobs, it's a bigger house that sits there. This has pushed household debt to over 200% of income, the highest in the world. Let's put that in perspective. But here's where it gets darker. The population is rich on paper, but leveraged to the hilt in practice. And when you combine household debt at 200% of income with an economy that's increasingly dependent on oil revenues, you're looking at a ticking time bomb. The question is, how long until it goes off? The answer is coming, but first you need to understand something about Norwegian psychology. They've become so comfortable that they don't even see the bomb anymore. And that's the real danger. And the official statistics hide just how bad it really is. If you look at the headline numbers, Norway seems incredibly productive. Supposedly, 36% more efficient than the United States. But that is a statistical mirage created by the astronomical value of oil per man-hour. Strip away the hyper-efficient offshore sector and the reality is sobering. Mainland productivity drops to about $65 per hour. That puts them behind their neighbors in Sweden, behind the UK, and far behind the creative output of the US. Without the oil subsidy, the Norwegian worker isn't superhuman, they're just expensive. This is the real cost of comfort. The safety net has become a hammock. Because the oil revenue is so reliable, the hunger required to innovate has faded. You see this in the R&D spending. Sweden, which has no oil, spends 3.4% of its GDP on research and development. They have to invent to survive, which is why they gave us Spotify, IKEA, and Volvo. Norway spends just 1.56%, less than half. And when a country stops investing in innovation, its future prospects darken. So we have a country that's rich, comfortable, and stagnating. The question isn't whether they can fix it, it's whether they will. And that's where things get interesting. Because the clock just started ticking. The illusion of infinite time is shattering because the geology is shifting. The Johan Sverdrup oil field, the massive cash cow that has single-handedly propped up recent export numbers, has plateaued. Declining production began in 2025. This signals the end of the easy growth era for the fund's inflows. The faucet isn't turning off, but the pressure is dropping. And for the first time, Norway has to figure out how to replace the engine while the car is moving. Here's the crazy part. They actually have a map. A recent blueprint dubbed Norway Tomorrow outlines exactly how the nation could pivot. It identifies 10 specific opportunity industries where Norway has a natural right to win. Sectors like hydrogen, offshore wind, batteries, industrial software, and circularity. The math behind this roadmap is compelling. These industries could generate 210,000 new jobs and add 310 billion Norwegian krone in value by 2030. This is not a random number. It represents the replacement value for roughly 70% of the current GDP contribution from oil and gas. On paper, it's the perfect solution. So why isn't Norway building it right now? Why is the world's richest country sitting on a roadmap to its own future and doing nothing? The answer is the $2 trillion paradox. Norway has the capital to fund this transition 20 times over, but the fund is structurally prohibited from doing it. The golden straitjacket that mandates 100% foreign investment means a $2 trillion vault is legally banned from building the Norway Tomorrow roadmap. Building gigafactories, green maritime infrastructure, or hydrogen plants requires massive upfront capital expenditure, the kind of risky strategic investment that the fund's conservative mandate explicitly forbids. So here's the irony. The 3% rule was designed to prevent inflation, but it's created something worse. It ensures that while Norway owns a slice of the world's innovation, it isn't building much of its own. Norway is a strategic investor in everyone's future except its own. This paralysis is reinforced by political gridlock. The wealth has made the electorate risk-averse rather than ambitious. Consider the recent government budget debates. Instead of investing in new industries, politicians argue about how much to withdraw from the fund. They're managing decline, not building the future. The comfort of the oil check has made the messy, difficult work of building new heavy industries seem optional. They've forgotten that an economy is not a portfolio of stocks. It is a machine that makes things. The fund can buy every company in the S&P 500, but it cannot buy a new economy for Norway once the oil wells run dry. Here's the thing. Norway isn't facing this challenge because they were unlucky. They are facing it because they were too lucky. When the oil finally runs dry and the safety net disappears, Norwegians will have to learn to work again. That choice, between comfort and hunger, is the builder's dilemma. Norway solved the incredibly difficult problem of saving wealth, but they have completely failed the harder problem of allocating it productively. They built a vault when they needed a workshop. A savings account is not an economy, and $2 trillion passively tracking the stock market cannot teach a workforce how to innovate when the safety net is finally removed. The fund was designed to provide for the future, but it has calcified into an anchor for the present. Subscribe to see which other European economies are quietly failing behind the scenes.